Picture this. You walk into a buffet with 500 different dishes laid out. Huge selection. Your eyes don't know where to land. But then you notice something weird. There's a 30-minute line for just 7 plates in the middle of the table, while the other 493 are quietly going cold off to the side. That's basically what the US stock market looks like right now. On paper, the S&P 500 has 500 companies in it. In practice, a huge chunk of the index's weight, and a surprisingly large share of its recent performance, comes down to about 7 tickers. And here's the uncomfortable part. This isn't the first time investors have convinced themselves that owning a huge basket of stocks means they're actually protected from risk. 50 years ago, investors made a remarkably similar mistake. They confused owning the best companies with being safe from losses, and it didn't end well. The diversification illusion. Here's why this matters. If you own an index fund, have money in a 401k, or hold an S&P 500 ETF, you probably think you're spreading your money across hundreds of companies. And technically, you are. But an S&P 500 index isn't a buffet where every dish gets the same size plate. The bigger a company gets, the more weight it carries in the index, which sounds perfectly reasonable, until a handful of companies get so enormous that they start carrying a huge portion of the entire thing. Think of it like an elevator held up by 500 cables. Sounds pretty safe. Then you find out that 7 of those cables are doing most of the actual lifting. The other 493 are still there. They're just not carrying nearly as much weight. And that changes what you're really betting on. Because if those 7 companies keep winning, great. But if something goes wrong, you're not taking 7 separate little risks. You're taking one very large bet on the same group of companies continuing to dominate. And that brings us to a market that looked remarkably diversified on paper, but was actually much more concentrated than investors realized. The Nifty 50. When 50 stocks became the safe bet. After World War II, America rode roughly 25 years of near nonstop growth. The economy ballooned, paychecks got fatter, and by the early 1970s, the stock market had multiplied several times over. Investors had plenty of reasons to feel confident, and that confidence eventually changed the way people thought about risk. Pension funds and institutional investors suddenly had a strange problem. There was a huge amount of money looking for somewhere to go, while the rules made it risky for fund managers to stray too far from conventional blue-chip investments. Back then, there was a legal standard known as the prudent man rule. In plain English, the rule pushed people managing other people's money toward investments that looked safe and responsible. And blue-chip household names fit that description perfectly. So if you bought a respected company and the price later fell, it was much easier to defend that decision than buying some unknown risky stock. That's how roughly 50 companies became the stocks that investors felt comfortable buying and simply holding. They became known as the Nifty 50, and they were called one-decision stocks. The idea was basically buy once, hold forever. No follow-up required. These weren't sketchy startups either. They were companies like Coca-Cola, McDonald's, American Express, Xerox, Polaroid, Disney, and other household names. They had strong businesses, recognizable brands, and stable cash flows. The problem wasn't that investors picked terrible companies. The problem was that the quality of the business slowly replaced the question of price. Once enough people started thinking, this is one of the best companies in America, so why would I ever sell it? The next question became, why should I care what price I pay? And that's where things started getting dangerous.
When great companies become too expensive. By the early 1970s, the Nifty 50 weren't just popular, they were expensive, really expensive. The broader market traded at roughly 20 times earnings. Pretty reasonable. Meanwhile, Polaroid was trading at nearly 90 times earnings. McDonald's was up near 90, Disney was around 70. At that point, you're not really investing anymore. You're collecting rare stamps. Except instead of stamps, you're collecting shares of burger chains and camera companies. And this is the part investors often miss when they look back at bubbles. The companies themselves don't have to be bad. In fact, they can be incredible. You can buy an amazing business and still make a terrible investment if you pay too much for it. That's the lesson. A great company is not automatically a great stock at every price. But in 1972, investors were paying a massive premium for the feeling that these companies were basically untouchable. They weren't just buying businesses, they were buying certainty. And certainty turned out to be incredibly expensive. Then reality changed the rules. Then the environment changed. In 1973, OPEC nations imposed an oil embargo on the West over the conflict in the Middle East. Oil prices basically quadrupled. Inflation surged. Economic growth slowed. Unemployment eventually climbed from around 4.5% to 9%. The economy got hit with rising prices and slowing growth at the same time. Stagflation. And suddenly, all those assumptions investors had built into stock prices started falling apart. The overall market plunged nearly 50% between 1973 and 1974. And the stocks everyone thought were safest got hit especially hard. Because the further a stock price drifts away from what the business is actually worth, the harder the trip back down tends to be. Polaroid lost more than 90% of its value. McDonald's dropped more than 70%. And even some of the strongest household names suffered brutal declines. The companies didn't suddenly become worthless businesses. Investors simply discovered that an excellent business can still be a terrible investment when you pay an absurd price for it. The certainty tax. And this is where the Nifty 50 story gets really interesting. The lesson isn't, don't invest in great companies. It's not even, don't put too much money into a small group of stocks. The real lesson is that investors can pay an enormous premium for the feeling of certainty. Call it the certainty tax. Back in the 1970s, investors believed certain companies were too dominant to fail, so they were willing to pay almost any price to own them. And when that certainty disappeared, nobody refunded the premium. The same psychological trap can happen today. Fast forward 50 years and we have another group of companies that investors increasingly treat as indispensable. The Magnificent Seven. Same psychology, better technology. Microsoft, Apple, Google, Amazon, Meta, Tesla, Nvidia. These 7 companies make up roughly a third of the S&P 500. And to be fair, these aren't random companies. They run the cloud, they make the chips, they dominate search, social media, advertising, e-commerce, and increasingly, artificial intelligence. They're genuinely dominant businesses. But being a great company and being fairly priced are two completely different things. And that's exactly where the Nifty 50 comparison becomes useful. Today's investors have their own version of the one decision stock. The argument isn't that these companies can't fall, it's that they are so powerful, so profitable, and so important to the economy that owning them feels almost mandatory. And when enough investors feel that way at the same time, concentration can become self-reinforcing. The bigger they get, the more weight they have in the index. And the more weight they have, the more influence they have on the index itself. So when new money flows into an S&P 500 index fund, more of that money naturally goes toward the biggest companies. That can make an already concentrated market even more concentrated. That doesn't mean a crash is guaranteed. It means the risk is much less diversified than the label S&P 500 makes it sound. Don't panic, know what you own. So does this mean you should dump every tech stock tomorrow and move to a cabin in the woods? No. The Nifty 50 lesson isn't don't buy great companies. It's know exactly what you're paying for. And more importantly, know what you're actually exposed to. First, look at how much of your index fund is concentrated in the top 7 names. Most people are surprised by the number once they actually check. Second, remember that equal weight versions of major indexes exist. Instead of letting the biggest companies dominate the portfolio, they give roughly the same weight to each company. That doesn't automatically make them better, it just gives you a different type of exposure. And third, be suspicious whenever you hear that a company can't possibly go down. That's usually the exact moment when investors have stopped thinking about risk. Concentration isn't automatically bad. The biggest companies deserve to be big if they earn it. The point is simply to choose that concentration on purpose instead of discovering later that your diversified portfolio was really one giant bet wearing a 500 company disguise. The tickers change, the psychology doesn't. The companies change, the technology changes, the economy changes, but investor psychology has a strange habit of staying exactly the same. In the 1970s, investors had Coca-Cola, McDonald's, Polaroid, Xerox, and the rest of the Nifty 50. Today, we have Microsoft, Apple, Amazon, Nvidia, Meta, Google, and Tesla. Different businesses, different technology, same basic temptation. Find the companies everyone agrees are incredible. Convince yourself they are too important to fail. Then forget to ask the one question that matters. How much am I paying? The Nifty 50 didn't teach investors that great companies are dangerous. It taught them that great companies can become dangerous when everyone agrees they're worth any price. And the market eventually has a way of reminding people that no company is too good for gravity. Because diversification isn't just about how many stocks you own, it's about how much of your portfolio depends on the same thing going right. So next time someone tells you a stock is one you simply can't afford not to own, picture that buffet with 500 dishes and a 30-minute line for 7 plates. Great food is still not a reason to pay literally any price for it.